But I think the biggest thing here is the Fed really, and this is what I've been, yelling at the top of my lungs, is the Fed has to be so careful here, because if they trigger a bad recession, ask yourself, how do we get out of that recession? Because every past recession we've gotten into over the last 10, 20 years, the Fed has printed us out of. And if inflation is as sticky as it looks, they can't do that in the future. And so if they trigger a bad recession, we may be stuck in that recession for years. And we may have stagflation, all these negatives. And I think that's a real thing. If I was on the Federal Reserve Board, which I'm not, but if I was, I would be saying, Jerome Powell, be careful here, because you go too hard and too heavy, you're going to trigger this recession, and then we can't get the economy out of that recession.
Hello, and welcome to Wealthy Value. In today's video, Chief Market Strategist at InTheMoneyStocks.com, Gareth Soloway, updates about the current situation of the economy, including why he believes that we're living through the dot-com blowup of the crypto markets and the market's response to the updated CPI report. Gareth also predicts about a massive market sell-off in the coming days. Make sure to stick around till the end of this video, where Gareth Soloway talks about recession, Fed's policies, and rate hikes. If you like the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
My worst case scenario, and again, 12 to 13,000 is kind of my gravy zone. That's my high-end target. But I could see 3,500. That would be a 95% decline. And that would basically align us with what Amazon did in the dot-com bubble collapse. So again, think of the behemoth Amazon. By the way, think of how awesome it did. If you bought it even at the highs of the dot-com bubble, you made a fortune in Amazon. I still think that's the way it's going to be for crypto. So if you're in at 69,000, it sucks right now, but I do think you'll end up making money. For those of us that have some dry powder, you have to think that when it gets to those lows, everyone is going to be freaking out. That's when you want to deploy some capital, obviously capital that. So I think that's definitely a chart you want to pay attention to, because just like the individual charts of the cryptocurrencies, it does tell a story. So it tells you about how much money was chasing at the highs. The head and shoulders, like you said, is absolutely crystal clear there. And interestingly enough, one interesting comparison, at the height of the dot-com era, guess what the market cap was of all the dot-com stocks? Right around $3 trillion. So a weird parity there as well with cryptocurrency top, which was right around $3 trillion as well. And now we're kind of living through that dot-com blow up of the crypto market. So, I mean, I was in the camp of 50 and then an additional 25 into year end. I think you have to think 75 now. This is the 10-year yield chart. 10-year yield is nearing that 3.5 double top. So again, I don't know if we'll double top and pull back here, which would indicate that markets start to think the Fed may do the 75 and then kind of sit on the sidelines. But it certainly is something I'm watching. But I would say, again, what I hope the Fed does is, if they're going to do 75, I hope that they sit on the sidelines for a couple months for the sake of the economy, for the sake of everyone else. I do think inflation will come down. It's just kind of lagging at this stage. And so I just hope that they don't overdo it too much, push us into a dramatic recession. Then you see unemployment go sky high, 8%, 10%. And I do worry that that could be what the path they're on. So going into year end, I mean, I hope that they only do another 25 after this next. No, I think he's on point with 75. And the key is, going into this number, honestly, I was in the 50 basis point camp, because I mean, looking at gas prices, oil, copper, all these commodities have fallen dramatically. And so in my head, I'm like, okay, well, we should see that trickle through to the consumer price index. And we just did not. And I think the market got caught way off guard. The Fed now is locked in at 75. I think that's a no-brainer. The reason why I don't think there's 100 is because technically the Fed is really tightening additionally by unloading their balance sheet. So I believe in September, they started to reduce their balance sheet. And by reducing their balance sheet, it's technically a tightening effect as well. So if they do 75, it probably, with the unloading of their balance sheet, it's the equivalent of 100 basis points. So market does not like it. Crypto doesn't like it. Stocks don't like it. It's just risk off all the way around. So usually the way it works is that the markets, after today's data, they're readjusting very, very quickly. There'll probably be an additional readjustment for the next couple days. And then by the time you get to Friday, the markets will probably be priced in to 75, maybe 100. And they'll just sit there and kind of go sideways until we get that data from the Federal Reserve. So the market is in that. So anytime the market gets information it didn't expect, it quickly tries to readjust to factor those expectations in. and then until it gets new information, it'll kind of hover around that level. So that's what I'm expecting, some volatility in the next few days, and then getting into a quiet period into the I know you've traded for many years, but you know, you don't see a bottom until the VIX goes nuts, right? So like you want to see 30% move in the VIX where you have that fear, and then you get a bottom. You know, 7% to me, I'm like, man, you know, that's not a bottom.
Just getting started, right?
Just getting started. Yeah, what it tells me is that the supply chain is still an issue. That's still keeping prices up. It also tells me wage pressures mean that companies have to charge more for their products because they're paying their employees so much more over the past 12 months. And all of these are then negating the drop in oil. I mean, imagine if oil was still at $120 a barrel, where we would be at that point.
Oh my God.
So, you know, it's definitely not a good position, and you can see from the market reaction, it freaked out the markets. I mean, this was, in terms of a trader's dream, this is what you love, but an investor, man, you just shake your head at it, and you kind of just look to fight another day. Yeah, so this is the NASDAQ 100, and again, look at this, down 4.3% on the day for the NASDAQ 100. That is probably one of the bigger drops we have seen in one day in a long time. And what you can really see here is that the market going into the CPI number was rallying up because it thought we were going to see a reduction in inflation, lower inflation data. And in one day, you've wiped out 1, 2, basically 3 up days in a row. You've wiped those, and those were big up days. I mean, the S&P was up over 1% on all those days. You've now wiped it all out in one single day. And that's, technically speaking, that does a lot of damage. The one line I'm really looking at now is from this low in June to this low that we put in early September. That's your big support line. So I'm watching that closely. Can it hold going into the Fed? Do we retest it? Does it break below? I mean, how does it all play out? But if we break this line, guess where you're headed? You're headed all the way down to the June lows right here. And that would be another nasty sell. So yesterday the last couple days, I was taking some of my longs off the table. There were stocks like NET and some of these other kind of tech stocks that had rallied significantly. So we were looking to take some of those off the table. And then yesterday I bought SDS and QID. So got exposure to the short side of the S&P. And I'll show you why. I mean, it was really kind of cool to see. If we go to the SPY chart, pre-market, by the way, we were up. And in fact, yesterday, look at this. So as a technician, you had a 4-day up move right into this pivot, which then coincides with this little pivot right there. And then it makes sense. 4 days up, got to have that pullback right off this little area right in here. So I didn't have a ton of short exposure out there, but I certainly got that exposure after that 4-day rally. Crypto-wise, I mean, you're seeing Bitcoin get slammed today. That's a nasty fall on Bitcoin. Now, interestingly enough, it came after 6 up days in a row. So 6 up days. You could argue that you were due for a pullback. The question is it just a pullback to support right here? This is where you should have support right around 20,400. If it holds that, maybe it gets another up move. I'm still in the camp, though, that when all is said and done, 6-12 months from now, we're going to have seen crypto and Bitcoin go down quite a bit more before all is done. The inflation we're seeing is in spite of a 15% strengthening of the US dollar since the start of the year. So imagine if the dollar was flat or negative on the year. That's the one saving grace, I think, that at least if you go to another country, like you can go to Europe right now or Japan, and your dollar goes really far in terms of taking a nice vacation. But needless to say, it is the dollar. And by the way, it's very rare for the dollar to go up and the bond market to drop, meaning yields going up at the same time. That is super rare. Not a good scenario at all. That's kind of like the death march, if you will, for the overall economy. So it's something that, again, people are going into the dollar because of safety. They're very concerned about geopolitical things, Russia, Ukraine, China, Taiwan. Then you throw in potential global recession. That's making people buy the dollar. Then the Fed is tightening, which is sucking dollars out of the system. That's strengthening the dollar as well. So all of these factors are kind of coming together to create what I would worry would be that black swan event where you could get some major breakage in the system. And then the question is, you get a major breakage, what's the Fed going to do? With 8% inflation, can they print us out of that? I mean, it's nuts right now.
They've thrown all their arrows, right? There's pretty much no more tools available. What do you have here in the Dixie? What are you seeing?
So this is a trend line that I have on that I'm paying attention to. Right now, we're holding this trend line. If at some point the Dixie, the DXY breaks it, then that would potentially be a new phase. That could be the marker where the Fed starts to sit on the sidelines. It could be the marker where interest rates start to fall, the dollar starts to weaken. Maybe there's a comeback in the economy, or at least in the stock market and the crypto markets. But I think as long as you remain above that line, you have to think that markets are going to be very tricky in terms of going up. The fact that the 2-year is going up and well past the 10-year at this point, that's even more inversion of the yield curve, right? And basically, inversion of the yield curve is the market telling you that a recession is coming. So again, it's been a great historical predictor. The fact that we're this kind of inverted is even worse for the overall economy in terms of a kind of a signal of what is to come. But bottom line is, I mean, people are scrambling, and bond market traders are scrambling. These moves are historically out of control to see the bond market make these type of moves. And again, it's the market trying to come to grips with everything that is going on: inflation, geo instability, the economy, COVID's recovery. I mean, all of that stuff it's trying to price in, and right now it's basically flailing to try to figure it out.
So, what are your thoughts about Gareth's warning of an upcoming market sell-off? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.